This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel, and this is the weekend's deep dive. In case you're new here, on the weekend, we like to come back and re-examine the base case hypothesis that this channel has held pretty much since its inception. Check in on it and make sure that, largely speaking, things are still going according to plan. If they are, then I can continue to have confidence in my posturing and in my positioning. And if things start to go wrong, then of course I need to be aware of that in the first instance so that we can start to adapt and change to an ever-changing market. So from the top, we're going to run through this thing as we always do and see if things are still going according to plan. First of all, for the stock market, the idea was pretty simple. At the lows, I said everyone was too bearish. We'd probably have a blow off top to all-time highs, and then we would come tumbling down in a global bear market and recession. I also was suggesting that we would see a deflationary period for a short while during the bottom of this bear market, and you'll see why in a moment. Fast forward to today, and it seems like it is playing out, largely speaking, as expected. For me, as it stands at the moment, the base case is that whilst we are probably going to get some relief here off of this first angle, we are actually going to form a lower high and roll over and continue this bear market. I would love nothing more than to see this be invalidated, to see us move up to a new all-time high and be able to continue to trade this trend to the long side into new price extremes. But as it stands at the moment, due to the third angle violation, the second angle violation, and the failed daily cycle, to me, the trend has truly changed direction here, and any relief here will be used to sell into and then start to look for ultra high probability short setups. Again, I'm always open to pivot in if the market proves me otherwise, but so far, I would say so good for the stock market. For Bitcoin, we have been operating under the assumption that we're going to find a weekly cycle low and then have one final push to some new all-time highs. And when we take a look at this, the yellow squiggle has largely speaking played out, although this has taken a little longer than anticipated. I still maintain that we do have another squeeze to the upside here, and I think this weekly cycle low will work itself out sometime around early May, as you'll see when we get to the TA at the end. So I remain cautiously optimistic here, and I know a lot of people will say, well, how can you be calling for the stocks to make a lower high and Bitcoin to make new higher highs? And to that I simply say, trade the chart in front of you. Okay, I'm not going to assume any correlation. If this thing produces a lower high and rolls over too, then we will deal with that as and when it presents. For now though, we stick with this until invalidated. And notice how the bears have had a good couple of attempts here to push the price to new lower extremes, and they have failed. Okay, there's loads and loads of logical levels around here, and we haven't managed to get to any of them yet. Doesn't mean it can't happen, it just means it hasn't happened yet. And therefore I remain cautiously optimistic that the bears just don't have the momentum to the downside at this current moment in time. I also make the case that this is slowly but surely morphing into a true weekly cycle, and all prior weekly cycles have resulted to approximately a 100% upside move, which would give us a target of somewhere in the neighborhood of 150-ish K. Are we more than happy with that? So as I said at the start, if we are going to have a global bear market and recession, I think there's going to be a deflationary component this time around. The idea for this is quite simple. Anything you do to the M2 rate of change shows up in the CPI with a lag. Since we had such a violent snap to the upside in the C19 era, I've been making the case that all forces have an equal and opposing reaction. And thus the snapback will be very violent and this thing will slip into a short period of asset price deflation. Here's a more updated chart for the people that want the updated chart. I'm still making the case that this final push down here in the M2 rate of change has yet to show up in the CPI, but I do think it's well on its way, and we got some new data this week that absolutely confirms that in my view. We continue to use Trueflation to track the overall trend, and as you can see at the hard right edge, the trend is continuing to be disinflationary. And we got inflation come out this week, CPI, core, all cold, okay, all disinflationary, all continuing to confirm that we are on the right side of this trade. Similarly, we got PPI come in and it was actually deflationary month over month for both core and headline, continuing to move in the right direction, continuing to move in the direction expected. Happy days there, we'll tick that off as well. We know unemployment is remaining relatively stable at the moment, but still at somewhat of a concerning level. And when we look at things like U6, okay, we can indeed see that we are turning up, and usually this is a precursor to recessionary periods. We also have a similar look where we have the lead-in phase for the SAM recession rule, which usually precedes an accelerative move to the upside that coincides with a recession, as per the prior instances shaded on this chart. And so, of course, if we are going to be moving into a bear market and a global recession, all of this makes sense that we would slowly but surely see the unemployment deteriorate, and that appears to be what we are seeing for now at least. GDP is holding up relatively well, and I actually think the next readout is going to be surprisingly high. The reason I say that is the tariffs at the moment, people knew about for many months in advance. They knew tariffs would probably come in. Trump had signaled that to the world. And of course, when people know that they're going to have to pay higher prices in the future, they usually rush out to buy things before the tariffs hit and thus be able to lock in cheaper prices before the tariffs come into effect. And I actually think what this is going to do is squeeze the GDP number higher, creating the illusion everything is growing, everything's doing well, and then I think we're going to get the snapback in the following readout. So it will be interesting to see if this theory continues to play. We have also had the bond market and the CME struggling to figure out what the probability of seeing rate cuts in May's meeting is. So far, it seems like with near certainty, we are not getting out of June without seeing some rate cuts. But the volatility in this pricing has been extreme, and I on this channel continue to make the case that this policy is overly restrictive. I think the Fed is far too late behind the curve of inflation, and I also think it's too late behind the lead-in phase before the acceleration in the unemployment data. I think if they continue to remain paused, then we are really going to start to exacerbate the downside moves that we see out of the lower high here, which I think ultimately will result in them panic cutting. We also continue to track things like the Chicago PMI, which although has creeped up from 45 to 47, continues to sit below the 50 level, indicative of economic contraction. PMI not looking super convincing at this moment in time. Something else we track every weekend is the high yield credit spreads, and this for me is where the first real warning sign is starting to show here. I've long been drawing this trend line and saying any kind of breakout is synonymous with financially stressed conditions, and for the first time in a long time at the hard right edge we have a breakout. Now, given the amount of volatility we've seen, given the amount of panic and uncertainty out there, it's entirely possible this move is reversed. Okay, but we only have to scroll out on this chart a little bit to see that these pushes to the upside are usually synonymous with financially stressed conditions. So I really think this needs to roll over here, because if it continues to push higher, then it is going to confirm that that indeed was the top. We really have had a trend change here, and the best we can possibly hope for is a lower high before a big rollover. And of course, the printing that we saw during the C19 era has created a have and a have-not economy. Around half the people are walking around richer than ever. Those are the asset holders, the people that had gold and Bitcoin and other assets. They were able to preserve and grow their wealth as a result of benefiting from the debasement of fiat currency. But the other half of the economy is walking around poorer than ever. And we can see that here in the amount of bankruptcies and delinquencies that I'm going to show you next. So first of all, in the US, bankruptcies are skyrocketing. You can see this here. The weekly bankruptcy filing 4-week average jumped to 7, which is the most since the 2020 crisis. Outside of the 2020, this is the highest level since the GFC, as you can see on this chart. We can also see that 6.1 million Americans are in default on their mortgage payment. Okay, so again, this is not nothing. And the same is true of the car market, because we've got US auto loans 90-day plus delinquency rates just hitting 3%, which is the highest in 14 years, as you can see right here. And the delinquency rates for credit cards and commercial loans versus the recessionary periods, as you can see, starting again to look like a recessionary spike. It's also worth noting here that the delinquency rate on the credit card loans for banks outside of the top 100 is now higher than it was during the GFC. Okay, again, hard right edge here, significantly above the prior bubble pops. Also note, it seems to have peaked and turned down, synonymous with the recessionary part. So as we continue to follow this every weekend, as we continue to come back and examine this base case, it seems like we have actually surpassed the point of bull market here. Now, it can change, and it can change quickly. Anything can happen to completely reverse this and see us at new all-time highs. I know there are still plenty of people out there calling for new all-time highs, but we've been doing these episodes every week for about 3 years now, and slowly but surely we have been observing the data getting worse and worse. We've been observing the recession getting closer and closer. And it really, really now seems, to me at least, we are closer than ever to seeing this truly confirmed. And remember, all it will take is a lower high and a rollover here. And that's all she wrote. So again, I'm always open and hoping to seeing a big push to the upside. But so far, that cannot be the base case based on everything I've been presenting over and over and over again. Something else that is somewhat concerning to me, and I've been talking about again every week, is the yield curve inversion. I often say people get this wrong. When it inverts, people scream recession and you don't need to. When it reverts, people scream recession and you don't need to, because it is the acceleration to the upside that is synonymous with seeing the tops come in. When we move to the 10-2 yield curve, this is really starting to look like an accelerative change here. For a while we were getting away with it. For a while I was saying, you know, this sideways can continue indefinitely. I was also saying that if we start to creep up slowly, it's not the end of the world so long as we don't start to accelerate. But for the first time, this is starting to look accelerative to me, and I have been saying over and over again, if this top breakdown and trend reversal signal was for real, then by the time we got to the 10-2 yield curve accelerating, we would have to use this as true acceptance, as true confirmation that there are no new highs coming. And again, the lower high and rollover is the base case here. As we always do, we will change the 10-2 to a more sharper signal, which is the 10-year 3-month, and take a look at what's going on. And again, last week, we were watching this thing invert again back below zero and saying, well, that's at least something that hints at the idea we may be able to move higher in the stock market. But now since then, quite a big green candle on the weekly time frame. And again, it doesn't take much. 1, 2, 3 weeks here was all we got in the C19 era before it was confirmed, and stocks plunged significantly from the levels already. Now, given the amount of damage we've already done here, with the yield curves looking like this, it tells me that, you know, things could get very, very ugly very, very quick. It's only going to take 1 or 2 more candles like this, and the only reasonable thing to expect here would be something more like this. So pretty bad, right? To be completely honest with you. I think we really, really, really should be championing and hoping and praying that what we get is no more acceleration from here. More chop, more sideways. I would love to see that 10-2 yield curve that we showed a moment ago. This one right here, I would love to see this thing reverse, okay, and trade back down below these highs. And I really hope that that can all occur with these high yield credit spreads also showing a fake breakout look and reversing down back towards this breakout level. But as it stands, the base case has been, remember, that we would have a blow off top and come tumbling down in a global bear market and recession. The base case has been that this will be deflationary. The base case has been that unemployment will slowly but surely lead in and then deteriorate rapidly. And the base case has been that all of this stuff will occur because interest rates will be overly restrictive, the Fed will be late to react, and that we would be able to use the high yield credit spreads and the yield curve acceleration to confirm that the recession was truly taken hold. And so far, it seems very much to me like we've completed the 3 angles, we've come tumbling down. Undeniably, inflation continues to be in a disinflationary trend and heading for deflation. Undeniably, the unemployment has experienced the lead-in, and the only missing component is the acceleration to the upside. All of this happens very fast as things start to really spiral out of control. The interest rates are undeniably overly restrictive. The credit spreads are undeniably signaling that risky times potentially lie ahead. And the yield curves are really starting to confirm that all of my fears about all of this coming to fruition were indeed founded in reality the entire time. So with that said, moving into the charts, how are we going to deal with this? Well, again, to be really clear, we are still expecting a lower high and a rollover. And it is out of that lower high that I am looking to completely exit the market. I am looking to flip net short, and I am looking to move to being ultra defensive here until proven otherwise. We know from a cycle perspective, we've got a tradable low sometime around the 7th of May. And that is also synced up with Bitcoin's next daily cycle low, as well as gold's and even the dollar's. So I do think something like this rejection at resistance, cycle low, breakout, lower high, and then rollover could be on the cards. I hope, again, that we can move to all-time highs. But for now, at least, from a trading position perspective, I am merely looking to get long out of this cycle low, see how high it can run, and then look to be ultra defensive and flipping short on that ultra high probability short setup. Gold continues to blast off to new highs, and we know we got a weekly cycle low in focus, and we also know that this is cycle 1, 2, 3, now on the 4th daily cycle, which should in theory left translate and fail to give us a weekly cycle. So we continue to be positioned for this in the longer term accounts by gold and silver miners, ETFs and alike in the level 3 members section. But the expectation here is that this is just going to continue. Yes, there will be shakeouts along the way, but in my humble opinion, all dips are for buying indefinitely in the precious metal markets. Bitcoin also has that daily cycle low due for around the 7th of May, and so far it appears to be trying its best to find a bottom, trying its best to do a bit more chop and grind, and then I think it has that final push left in it. And again, we'll be looking to get long out of this daily and weekly cycle low and see what the market will give thereafter. So there's not much to do from a trading perspective until we get to that 7th of May time frame. Once we do, that also, by the way, coincides with FOMC. Once we get there, I think we'll be able to put some trades on. I think we'll be able to play some counter trend bounces. And then I guess it will just be a case of continuing to take this thing one day at a time. I really, really, really hope that there are more highs left across the board. I really hope that we're not going to go into a deflationary bear market immediately. But based on everything I've been showing you week in, week out, it certainly seems like it's pretty likely at this current moment in time. So things could change and they can change quickly, but they haven't changed yet. I'm your boy Camel. I hope you're doing well. I hope you have a fantastic weekend. If you're a level 3 member, look out for the members only video I'm about to post for you guys. And other than that, until next time, take care. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel